Hi guys, checking again. This can everybody hear me? Yeah, great.
Perfectly, yes, perfectly.
We
Yes.
were having an issue with the YouTube link. For some reason, it was not transmitting. It's still not transmitting. We need to start. So what I'm gonna do, I'm recording this and then I'll upload to the YouTube channel later on. So we're not gonna be live today, but we are being recorded and this is gonna be online afterwards. All right. So without further ado, let us begin. It is with great pleasure that, let me see if he's on. Yeah. It's with great pleasure that we have here today Ricardo. And I've already introduced you and all the invited professors yesterday, but Ricardo, thank you very much. I see your book recently published on the topic here, and it's wonderful to have you here. So, yeah, the the merchandising is already done, guys. Please, it's a great book. It's his thesis that it's already on the readings, but now published as a book. And it's a pleasure to have Ricardo with us, and he'll talk about the scope of the rules. And as of yesterday, we left off on when we were beginning to discuss the 5 fundamental steps to applying Globe. And what I agreed with Ricardo is that he would get into the 5 fundamental steps. So you get rid of me talking solely on this topic, and we'll do a kind of an interplay. And then we'll get into the scope and the other issues that we have scheduled for today. So, Ricardo, nice having you here. The floor is yours. I'll share the slides and you can go ahead. Thank you.
So good afternoon. Thank you for having me. It's a pleasure to be here. It's a great initiative to share knowledge. Um, I would say globally now because of the idea of streaming it via YouTube. And it's great to be back home, I would say. This is my alma mater. This is where I went to law school, where I did my master's. The PhD, which is this book I wrote in Cologne, but with great influence from Professor Schwady and from all the colleagues back home. And this copy is for Gustavo. He's been a great influence throughout the years, and it's a pleasure to give him this copy. Um, so maybe I should stand. It's better. Is it okay for the camera? Am I on?
So far, it's perfect.
Okay. Professor Sherry says it's good, so.
We cannot see the screen quite well. Now,
Yeah, it's
now,
coming.
now, let's see. Now we have this. We have it.
Do we have the thing to pass the slides or? Okay. So I will go briefly through the structure of the presentation. So it basically has two parts, and I hope you all participate to the extent you wish to. So the first part, as Gustavo mentioned, I will address a bit of the context of the rules and then the general functioning of the globe model rules with focus on the five-step approach. Part two is perhaps a more fundamental, more theoretical discussion on the subjective scope. So who is the subject of the globe model rules? Which are the policy choices in the definition of a mini group? And a bit on the objective scope. So we will discuss whether the pillar 2 rules or the globe rules, they are focused on economic rent. In this first part, I will share the presentation with Gustavo. So we will go through all the 5 steps. And I will present it briefly, and then he will also make considerations on each of the steps. And of course, you are all invited to speak as well. It doesn't have to be a question. If you have just something to say, just say it. So just please come here to the microphone. I know it's a bit annoying, but it's important for everyone to listen to your ideas. Okay, so on the context, uh, the structure of the rules has been conceived or has been discussed since at least the BEPS final reports. So at the end of the BEPS project, it was clear that uh, something was missing, something more should be done. So even though they try to address the base erosion through specific measures aimed at specific features of the international tax system, international tax regime, as you want to call it, uh, at the end of the day, it became clear that uh, even though all the measures were undertaken, something else was still necessary. And this something else was the so-called floor to tax competition. Uh, so the perception of the OECD and the inclusive framework was that the BEPS actions were not enough, and M&E groups were still able to use the difference of tax rates and calculation basis between jurisdictions to achieve a low effective tax rate globally. And here I have some of the main steps of this process. So there was a policy note in 2019, and then several public consultation documents. 2020, there's an important economic impact assessment, which was later reviewed and completed with other analysis. And the global model rules finally came out in December 2021, followed a couple of months later by the commentary and the examples. And after that, we have a document on the safe harbor and other administrative guidances as well. Um, Dogmatically, if we look at the rules, what we see is an intent to establish a strong model of minimum taxation. So the idea was that countries would adopt uniform rules that would operate as a closed system with autonomous concepts to create this floor to international tax competition. So the idea is if everyone adopt rules as they please, unilateral measures would be enough. So what is the goal of a multilateral initiative? Is to, of course, establish a system that would be treated uniformly by the jurisdictions. And this is a challenge from an international tax law perspective, because this has never been done, at least to this extent. And of course, now we are forced to deal with these soft, soft law rules and treat them as if they were hard law. Because in my thesis, for instance, I deal with a set of soft legislation, but I treat it dogmatically as a closed system, as I'm suggesting here. And this is new. This is something that we didn't do before. And of course, when we refer to the global model rules, we are at the end of the day referring to domestic legislation patterned after the global model rules. And the global model rules, they still remain as an important point of reference. So even though we are, for instance, in Brazil with the discussions with the QDMTT, even though we have legislation, we have the normative, the administrative rules, We still need to look at the global model rules. We still look at the administrative guidance because we know that what matters is what's written there. And because of the way our legislation was drafted, we have very little flesh in the law. It's everything is in the administrative rules. So this need to look at the global model rules, the commentary, the administrative guidance is even more clear. Um, so this is basically a general background on why this is different for international tax law. What's different about the Pillar 2 project? The difference is that this is new. You know, we have never seen this before. This is a global initiative which demands the adoption by a critical mass. And perhaps you discussed this yesterday, what will happen if a critical mass is not on board. And the picture there is not very positive. So moving on, now we have looking what we can call reference documents. That's the name the Brazilian legislation gives them. I call them relevant material in the thesis. So we have basically the model rules, the commentary, the safe harbors and penalty relief, which is a document which was adopted by the inclusive framework and approved as such. And for this reason, it should have the same force as the administrative guidance. And we have one from February, another from July, December, all 2023. And these guidance were consolidated in 2024, and the consolidated commentary is already outdated because we have administrative guidance which came out after the consolidated commentary. So you should look at the model rules, the consolidated commentary, and the administrative guidance that came afterward, including the Global Information Return, which has some interesting analysis. This is the document that came out now in January. So this is basically the material which we treat as a closed system. Now on the functioning of the rules, I always say that I'm able to explain globe in 6.5 minutes. And this is my effort to do that. But perhaps it will be hard because I need to keep clicking. Okay. So the first step to apply the globe rules is to calculate the effective tax rate. So once you design your group, you conclude this is my M&E group, you have to calculate the effective tax rate. We will see on detail after that identifying the M&E group is not very simple. It may bring you some trouble, but in 6.5 minutes, that's what we can do. Here in my example, we are calculating the effective tax rates for the jurisdictions below the red line. So the jurisdiction here in green, both jurisdictions in green, they have the ETR above the minimum level, which is 15%. So we will have a problem only for subsidiary A. So the jurisdiction of subsidiary A is taxing subsidiary A at an effective tax rate which is below the minimum level. So for the other jurisdictions, we don't have to do any further calculations. We can stop here. So the problem will be the jurisdiction from subsidiary A. And we move on to a second step, which is calculating the jurisdictional top-up tax for that jurisdiction. The jurisdictional top-up tax is a tax like any other tax. It has a tax rate and a calculation basis. Okay, what makes the jurisdictional top-up tax a top-up tax is the tax rate, is the top-up tax percentage, which is the difference between the minimum rate and the ETR. So in our example, we concluded that the ETR was 10% for subsidiary A, which is going to be then the top-up tax percentage. We have 5%, which is the difference between the floor, the 15%, and the ETR. So that's the 5% top-up tax percentage, which is the tax rate for the top-up tax. The calculation basis is the excess profit, which is the difference between the net global income for the jurisdiction and the substance-based income exclusion. We will go into detail after a while, but for now, let's just assume that the excess profit is 200. 200 times 5% will have the jurisdictional top-up tax of 10. So this is the jurisdictional top-up tax that we have calculated for subsidiary A. And now we have to allocate this to an entity which will be charged this 10%. The rule order here is focused on the IIR. It's very important that you face the matter this way, because the preference to charge the top-up tax is from the UPE jurisdiction. If the UPE jurisdiction does not adopt the IIR, then subsidiary 1, the jurisdiction of subsidiary 1, can charge the 10 related to the undertaxed profits of subsidiary A. If neither UPE nor subsidiary 1 are charged, then the UTPR may come into force, and then other entities of the group may be charged on the UTPR, or under the UTPR, but there is the QDMTT, which is the defense mechanism that the host country has in order to guarantee that the profits arising in its jurisdiction are not charged under IIRs and UTPRs in other jurisdictions. So it's important that you think of the structure of the rules this way. So the QDMTT is, as we will see, it's a deduction in the calculation of the top-up tax. So the rule order is conceived this way. The QDMTT only came later. So when we look at the blueprint, the initial documents on Pillar 2, there is no reference to the QDMTT. The QDMTT only shows up in the Globe Model rules themselves, okay? So everything was structured to have the IIR as the main charging rule, the UTPR as the backstop rule. When the rules were first conceived, there was no idea of QDMTT. They were included during the negotiation process, and they make a lot of sense. The QDMTT guarantees the right of the host country to tax its own entities. Okay?
It's only natural. Well, it's only natural if you think about who developed these things, not to think of it. But logically, I mean, well, if the host country taxes, then it's all and done. Then you have an effective rate superior than 15, and there you go. You don't need to apply this whole thing. So it's natural in that sense for it to be out. And I think what the QDMTT really meant when it was put on, it was as a safe harbor. I know I'm not gonna get into that because you get into that in the proper lesson. But here's the kicker. The QDMTT should be viewed as a safe harbor, and that when we analyze the Colombian experience and compare it to Brazil with Natalia, that'll be the difference. I mean, what do you get when you get the stamp saying that your charge is a QDMTT in terms of how the multinational group will be able to deal with a no IIR and no UTPR in the other countries? So that is the thing. But even if it's not a QDMTT, and if no safe harbor, no QDMTT safe harbor was ever thought of, if you have an alternative minimum tax, or if your statutory corporate tax rate takes care of not having an effective tax rate under 15, well, then this thing will not, well, it will apply, but there will not be any IRR or UTPR due. So that was the logic, I guess. But it's and you always insisted on this point that QMDT came after, and when you look at our IRS saying, well, Pillar 2 was conceived for the QDMTT to be charged and not the rest. Well, that's not really the case. I mean, well, it kind of ended up being like that in a concession saying, hey, we know that this is the host country's right in the first place and not the other country's right, but it was not conceived for a QDMTT to be charged at all.
Yeah, I think this is really important because there's a lot of path dependency on the way the rules were structured. Because when you think, why do you use the consolidated financial statement of the UPE? Why do you use the gap of the UPE for this and this and that? And that's because of the origins. The origins were that the IIR should be the main charging rule. There was no idea that something like a QDMTT would come out. It only came later. And now we deal with issues. Okay, can the country adopting the QDMTT use its local gap? The global model rules, they make clear that they can. And this will be the preference for most jurisdictions. But then, because the IIR and the UTPR, they are necessarily calculated following the gap from the other jurisdictions, there will be inevitably a clash. And because of that, what is really important is that the QDMTT also qualifies for the QDMTT safe harbor. Then this clash won't arise. So that's why I'm stressing the importance of seeing the rule order this way, because otherwise you don't understand the nature of the rules at all. Sometimes you will think, why is this way? This doesn't make sense. I'm applying the QDMTT. Why do I address this and not that? The reason is history. So something came before the other. Okay. Any ideas from the audience? No? We can move on then. So now it gets a bit more complicated, not 3 steps anymore. Let's go to 5 steps. Uh, uh, just add all of them. So the 5 steps are the identification of the in-scope entities, the calculation of the globe income or loss, which is the denominator, the calculation of the adjusted cover taxes, which is the numerator, the calculation of the ETR and the top-up tax, and the imposition and allocation of the top-up tax. Today, we are going to go through these 4 steps, and we saved the last step for Thursday because that's a class on the charging rules, so we can go into more detail today on the other 4 steps, and the application of the charging rules will be left for Thursday.
Actually, today the main focus is the first step. Of course, we'll go through the other ones for us to get an overview and a grasp of everything. But today we'll focus on the first, which is the scope, and then on the 24th we will deal with calculation of global income and calculation of adjusted cover taxes. This will go on the 24th and the 25th, and then calculation of ETR and top-up tax will be our last lesson with Allison, which will be on the 28th, I guess. And finally, the imposition and allocation on the top-up tax, which are the charging rules. Ricardo will come back and talk to us. It'll be on Thursday? Yeah, Thursday this week. So there you go.
Yeah, and of course, this is the first layer of ink. So when you're painting a wall, there's always this first layer, and then you come with the second layer of ink. So I'm responsible for the first layer, and the second layer are the other professors. So the 5 steps, they are actually 20 sub-steps, okay? which we are going through today. So each of the 5 steps can be translated into another 4 or 5 steps. You can click them all. So we are going to go through all these sub steps today. So from the 1 to 4, and not 5 today. So let's just start it. Step 1 is the identification of in-scope entities. Uh, in the slides, I always have here the main provisions in the globe model rules. This will be material for you afterwards. So if you like, uh, to revisit the discussion. So the globe model rules, as you know, they apply to entities and PEs that are part of the M&E group with a consolidated group revenue that exceeds 750 million euros. There is a 2 out of 4 year test. So at least 2 of the preceding 4 consecutive fiscal years are the reference for the calculation of the consolidated group revenue. Importantly, the tested fiscal year, which is the current year, is not considered for the test. So in order to verify whether you are in scope, you need to look at 2 out of 4 years before the current year. And in that case, the group revenue shall exceed the 705 million euros. The consolidated financial statements of the ultimate parent entity are the relevant statement. The UPE is the entity that owns directly or indirectly a controlling interest in any other entity and is not owned with a controlling interest directly or indirectly by any other entity. So basically, an entity which is not controlled by another entity. The UP is the starting point to identify the entities which are part of the group. So basically, if you consolidate the entity in your consolidated financial statements, it is part of the group. Okay? There is also a so-called accounting consolidation test. So there are cases in which the UPE is in a jurisdiction where it is not subject to rules that require it to issue a consolidated financial statement. So what happens in this case? No problem from the globe model rules perspective. There is the deemed consolidation test. So you have to use the financial statements that should have been prepared in accordance with an authorized financial accounting standard. So it doesn't matter if you're not subject to this rule in the jurisdiction. For globe purposes, you still have to prepare the statement as if you were subject to it. Another feature of the definition of M&E group is that it needs to be multinational. This means that at least one entity or PE must be located in a different jurisdiction than the UPE jurisdiction. So my entities are all in one jurisdiction. I only have a PE outside my jurisdiction. Am I subject to the globe model rules? From this perspective, yes. A PE is enough. I have only one entity which is outside. My whole activity, I'm trying to expand. I'm trying to make my activity international. I don't care. For the globe model rules, this is not important. And this creates a really bad incentive. I heard from a case where it's a Brazilian group. They are really strong in Brazil and they were just initiating their international expansion and they have very low revenue outside Brazil. And because of the globe model rules, they are simply planning to abandon the international activities because they have important incentives in Brazil, which will be neutralized to a certain extent by the globe model rules, and this all at the price of going international. So the company basically says, okay, you don't want me to be an international company, I won't be. I will cease to perform activities outside Brazil. This may be a detrimental effect of the globe model rules.
Ricardo, let me ask you something. Just to understand, in case you have, let's say that you have a rich individual. My name now is Elon Musk. Could I decide as an individual to have companies in several countries, but never consolidating because at the end of the day, it's myself only 100. I have a company in the US, I have other companies in Germany, but they don't belong to one company, but rather to myself. How would this case be seen?
So Shueiri's question, if you get out of the scope, if you don't have a UPA as an entity, but as an individual, who is not an entity by definition, under Article 10, under Chapter 10, sorry. So if you would get out, if and the assumption here is that each individual entity have only presence in their particular country and not a PE and not own another entity in another country. Because if they do, then they will become an UPA. Ricardo, I have two questions, but let's go to.
Yeah, so basically, if any one of you here have control over uh, a multinational group, and you wish to, instead of controlling it through a holding that could be called an UPE, and instead you just separate the business in several holdings in order to avoid the application of the globe model rules, there's nothing the rules can do against it. So if you have, let's say you have a bank and you have a sandals company and you have a road constructor company all under the same holding, maybe for globe purposes, if you just separate and control the business directly, you could avoid the application of the globe model rules, but this may be a bit out of this world.
Gustavo, just sorry. I have just received an information from the Department of Audio from the law school. They say that the problem is that you first begin to save, then you begin the transmission, and you should have done the opposite. So maybe you could interrupt the saving, the gravação, then begin the transmitting YouTube and making again. That's the explanation.
To if sorry, Shweri, you kind of cut out in some parts. You're saying that we should try to start transmitting now.
No, first it was stop this saving, stop recording.
Uh-huh.
Then begin the transmission. Then you can record again.
But do you think the transmission
That's
will
what
work now? That's what they told.
You have just received an email which I received also.
Well, I'm not looking at my email, so I'll believe you. But I'll stop the recording and I'll try to transmit.
That's what they said.
Just a second. Just a second. How do I stop the recording on this thing? Oh, this is pause. Putz, não, tem que dar. Shreddy, I have no idea how do I stop the recording here on this thing.
Oh.
Aonde? Ah, mas ele pausa, né? Ele não para. All right, let's see if I can. No, there's not even the option for me to transmit. You know what? I'll just go on. Otherwise, we'll not finish in time, Shreddy, and then
Okay.
we'll upload. All right.
Okay.
It is what it is.
Just got it. I got this message here.
All right. Thank you. Yeah. Well, all right. So a couple of things. It is a far-fetched example, but as Paula was saying, and I know you're not the only one. I had other colleagues that have lived through examples like that. They do actually happen, but I still think they're outliers. And if you,
Gustavo,
of course, if
Gustavo.
you think of public corporations, if you wanna
Just-
if you wanna assess the stock market, then this is a no-go from the beginning. So it has to be non-public groups owned by a family, and the family needs, or by one person in a family, and this one person needs to control the entities without any subsidiaries, then you'll be out of the scope. Yeah, Shweti.
Oh, I saw it was not email, it was a message from so the message in Zoom from me, and they informed that this was the reason for the mistake, but that it's already transmitting now. So
Oh,
people are
okay.
now it's being transmitted.
All right. Okay, cool. So yeah, that it is a little bit far-fetched, but it kind of happens a lot, I guess. É raro, mas acontece muito. It's not like I say we say here, but it's not what this was designed for. Paulo, do you wanna give us a grasp of the example that you lived in? Uh, I need you to come here, though. Yeah, it's a short walk. It's a short walk.
It's just not a very common way to participate. So in the case, it was the Brazilian company had over 10 billion reais in revenues. So in the middle of the meeting, we were quite surprised when we discovered it was controlled by a single person that also had similar businesses in several other jurisdictions. So we were discussing Pillar 2 issues, and they were very concerned about this issue specifically. Should we be subject to Pillar 2 in Brazil because this person that controls the business has similar business in other jurisdictions? And it was funny because they had so much subventions and they were applying the thesis that they had a retail mandatos and they were not taxing subventions in general by CIT. So their effective tax rate in Brazil was 6%. And it was a huge deal to the company whether or not they were subject, but because they were growing in such an organic way and they never structured their international business, they were simply not subject to Pillar 2. And we had two other companies in the same sector that they were subject and they were adopting the same approach. So from a competition standpoint, I would say it was quite a significant example. And we also had cases of companies that were just starting to become international. One of them also was with Jose Arnaldo, so maybe he wants to report on that because I think he has further details in one of the cases. But what we've been discussing is when you move through the calculations and you actually exclude your substance-based profits, then you might be on a position that it becomes irrelevant whether or not you're subject to Pillar 2. So this is something we've been advising our clients not to panic before they take such a huge decision. And PE thresholds are quite flexible. You can move around them before you can have a rep office that is not a rep office before actually bringing a branch into it. So this is some of the background. I don't know if do you want to tell the outcome what the client decided in your case? Not to go. So yes. So yeah, so it was a pity. We discussed this case and I was like, tell them to do the full calculation, but So just to repeat what Zernaldo said, in his case, the client decided not to go forward with the internationalization. They wanted to incorporate a rep office in China, right? So it was quite initial phase of global business, and they decided not to move forward. They're gonna wait to see how the things go, and then they a PE. Yeah, so this rep office will be a PE, so that's why they decided to.
But sometimes, yeah, after the calculation, they will not be subject, but just to go through the whole thing and then figure it out and do the findings and everything is bad enough. So it's not about only the rate. So I can totally relate. Just one thing here that we're probably gonna get into later, but this relies fully on an accounting criteria. And this is something that we'll get back in a whole a lot of topics here. But for the scope, we already have full reliance on if we're talking about IFRS 10. So are you consolidating under IFRS 10? Then you're within the group. If you're not consolidating, then the entity is out of the group. And this is weird because we're used to not relying on accounting decisions and accounting rules or principles to decide on tax rules because they are unstable, they are subjective, and they can change with time because FRS 10 might change in the future, and it's a different body than tax legislator, and it's a different body than the OECD and inclusive framework. Of course, the inclusive framework might change the rule if IFRS 10 changes at some point in the future. But this codependency always can cause clashes. And here, to decide the scope, we are already relying on a consolidation criteria under an accounting rule. And the other thing that Ricardo was saying, well, if I'm not under an accounting criteria accepted under Pillar 2 on the UPE, well, then no problem. You need to translate it and you need to do a deemed consolidation test, which is under the AG, the first AG, the February 2023 AG, that tells you, well, you need to, for the consolidation, you need to use an acceptable accounting standard, and you need to do the consolidation test under the same standard. So you don't have a leeway just because you don't use an accounting standard and don't consolidate, you can't get out of it. On the other hand, if you do consolidate, or if you don't consolidate, but when you translate to the acceptable accounting standard, let's say IFRS, for example, you are not doing line by line consolidation. You do like a fair market because it's an investment entity, then you can get it out. You're not within the scope because you're out of IFRS 10, for example. You're not consolidating under that. So you're fully dependent on what criteria you're using for accounting purposes. And that can be a weird path to go just because of the whole subjectivity that you might be subject to and the whole future changes that you also might be subject to if the normatization on a different field changes. So yeah, that's something to look at.
The the transfer pricing rules, the scope of application are huge than the Globia because under the transfer price rules, I can be a related party of someone that is related with like a common control that is not applied here. So here is the consolidation an entity like on financial statements, but you can have another group of transactions that are out of here, but they are subject on transfer price rules. I don't.
I think so. There are different rules with different standards. So you can have a related party under transfer pricing and will not be subject under the consolidation under Globe. I don't know if vice versa, but there are different set of rules and you apply them separately. The one thing that we Mhm. Well, it really depends on which transfer pricing rules we're talking about. I mean, if we talk about our transfer pricing rules, but in other countries, the thresholds might vary. So we can affirm that to every place in the world, but you're right. However, to calculate the global income, you need to observe transfer pricing. So transactions with related parties and transfer pricing will be need to be on arm's length under transfer pricing rules, and that's something that we'll see later. But it's fun to look at this interplay.
Yes. So moving on. Uh, So the second step is to identify the constituent entity. So the CE is any entity or PE of a main entity included in an M&E group subject to the GLOBE rules, provided that it's not an excluded entity. And what is an entity? Entity is any legal person other than a natural person or an arrangement that prepares separate financial accounts such as a partnership or a trust. Uh, so very broad definitions here. And we also have an autonomous definition of PE, if you move on. The PE is a separate constituent entity. Uh, there is an autonomous concept of PE under the GLOBE model rules. Actually, there are 4 different concepts of PE, depending on whether there is a tax treaty in force, whether the jurisdiction has a domestic definition of PE. So watch out here. The interpretation may be tricky. Importantly, the profits of the PE are not blended with the profits of the main entity. So the PE is a standalone entity for GLOBE purposes. It's not blended with the main entity, it's treated separately. You basically, once you conclude this is a PE, you treat it as a constituent entity as a separate one. There's also a negative list of excluded entities. So everything I said before about constituent entities needs to be read in this context of excluded entities. Governmental entity, international organization, non-profit organization, pension fund, investment entity that is an UPE, real estate investment vehicle that is an UPE. They're all excluded entities. These are all, again, autonomous concepts. If you look at the domestic legislation and say this is a non-profit organization, is this sufficient for your entity to be excluded entity? No, you need to read the definition of non-profit organization and see whether you qualify. This is important because this definition is quite restrictive. So there are rules on the destination of the profits, on how much it is controlled, and there may be even clashes with the Brazilian immunity. So the entity is immune for constitutional purposes, but it may not qualify under this negative list of excluded entities, and this issue may be tricky. Entities owned by these excluded entities.
Ricardo, just to mention, maybe this could be one of the reasons why they chose to use the social contribution, not the income tax, because you could avoid such clashes at least.
Yeah, that's an interesting point, but Gustavo disagrees.
I would I would say no. This probably not was on. This was not on their mind, and especially because currently, if you look at the current system, you don't have an immunity, but you have an exemption, and the relevant entities that would have a clash. For example, if you have a sports club, there's an association, non-profit association, but it might not be under the definition. It will still be exempt by, if I'm not mistaken, Article 14 of Law 9249. You will still have an issue with CSL, even if the top up is a CSL and not an income tax per se under our law. So I don't think that's the reason why they chose. We'll get into this tomorrow, but it's clear that the reason why they chose is that they think there's a more flexible concept of income, there's a more flexible non-discrimination clause regarding CSSL. I don't agree with either. And of course, there's the third one that they don't need to share with the states and the municipalities. That one is a fact. The other 2 previous one is the excuse. I don't agree with either of the excuse, but Shwedi, I don't think it even crossed their minds the immunity thing, especially because all nonprofit associations and foundations are tax exempt from the CSL under Article 14 of Law 9249.
Come forward. there's a comment from the audience.
Because I was thinking about Bosch. Bosch is a foundation, and I think that this UPE, Bosch is a UPE of a group with subsidiaries, including Brazil. Uh, they are out of the scope of the rule because in this case, the non-profit organization is the UPE.
I wouldn't say anything about the concrete case, but let's try to face the issue hypothetically, if you like, Gustavo.
I don't, I might be wrong about this. I need to go back to the rules and see. But for example, a government can be an EP if it owns constituent entities. But so it doesn't mean an excluded entity cannot be an UPE if they are consolidating. I might be wrong about this. Ricardo, correct me if I'm wrong. But the exclusion is for what is below and not for the UPE. Am I wrong about that? Because I know that a government can be the UPE if they are consolidating companies underneath. That is on the first administrative guidance also. So I would guess that they will still be within the scope, but I might be wrong.
Yeah, so basically there's the definition of governmental entity. You have to see whether it qualifies there. And also there are requirements for the entities owned by these excluded entities to be considered excluded entities as well. So if you look at Article 1.1, on 151, 152, you will see the criteria for also for these entities owned by the excluded entities to be excluded as well. But the important thing is that there are three practical effects of being considered an excluded entity. The first one is that IIRs and UTPRs do not apply to excluded entities. Second, excluded entities, they do not have ancillary obligations or administrative obligations under the global model rules. And finally, the attributes of excluded entities are removed from the various computations of the globe model rules. So the adjusted cover taxes and the globe income, the ETR, does not take into account the numbers, the features of the excluded entities. Okay, but just pay attention to one thing. The revenue of excluded entities is still relevant for the 750 million euros threshold. So when you are calculating whether you have the 750 million euros revenue, you should take into consideration the revenue of the excluded entities as well. Okay? They are not relevant for IIRs, UTPRs. They can't be charged IIRs, UTPRs. They don't have administrative obligations. They are not considered for the purposes of calculating ETRs, cover taxes, and so on, but take their revenue into consideration for the 750 million trigger. Moving on. So another thing is to identify the location of each entity. So after you identified the group, you identified the constituent entities, you identified the excluded entities, you need to consider where are each of these entities located for globe purposes. The general principle is that fiscal residence is applied whenever possible. This means that the entity is located where it is a residence, the resident, the constituent entity, the entity defined as we saw. The PE is located where it is situated, and I said that there are 4 definitions of PE, and for each of these 4 definitions, there is a corresponding definition of its location. Okay, this is all detailed in the globe model rules. You also have specific treatment for transparent entities, for dual resident entities, and for stateless entities. Maybe a comment here on the stateless entities. You will have like numerous clauses of entities which are treated as stateless, which is basically cases where you can't identify their residence. And the outcome of that is that the entity will be subject to IIRs and UTPRs, but their cover tax will always be deemed to be zero. And it's not not blended with any other entity. So it's terrible to have an entity qualified as a stateless entity because it will be subject to the charging rules. It will have a cover tax of zero per definition, and you can't blend it with any other entity in the jurisdiction. So basically, all the global income of this entity will be subject to a 15% tax rate. Okay, in the Portuguese translation for stateless entities is entidade apátrida. So if you look up, it's an interesting translation. I like that. Um, so moving on, it's repetition of it's your slides. Let's skip it. You want to comment on this last part? Go ahead. So now we have the M&E group, we have the constituent entities, we have the excluded entities, and we know where each entity is located. So this was our step 1 with 4 sub-steps. Let's go to step 2, calculation of the global income or loss, which is the denominator of our ETR. So the denominator, for those who have some difficulty with that, is the one that goes below. Um, so the starting point for the calculating the denominator is the individual financial statement used in the consolidated financial statement before consolidation adjustments, including the effect of intragroup transactions. So we are saying until now everything about consolidated financial statements and this and that. But for the purpose of calculating the global income, the starting point is the individual financial statement. Okay, this might come as not very natural, so you need to disregard the consolidation adjustment. So you need to include the intragroup transactions. The net income of the entity must be determined using the same accounting standard applicable to the UPE in the preparation of the consolidated financial statement. This means that if you are making some kind of adjustments to adequate the financial statement to the consolidated financial statement of the UPE, this is the financial statement that will be treated as relevant. So the individual financial statement needs to follow the gap of the UP. And this, again, we are not talking about QDMTT yet, okay? We are talking about the general application for the purposes of IIRs and UTPRs. As I said, QDMTT for the purposes of the GLOBE rules is a deduction, okay? It's also possible to use another accounting standard, and there are 2 defined terms here, acceptable accounting standard and authorized accounting standard. The entity if the entity keeps financial statement based on that standard, if the information is reliable, if the use of the standard does not cause significant deviations in relation to the UPE standard, then this other standard can also be used. So this is very broad, I would say. Perhaps some idea on that, Gustavo?
It's just that, you know, you might have a case which is not far-fetched of a subsidiary IFRS and a controlling UPE with US GAAP, for example. Do we have significant deviations or not? So that's the question. I don't want to go into these details because we have a class for this, but so just to make the point clear.
Brazilian central bank, and this is a issue that some taxpayers are discussing with the state of Federal.
Yeah, for regulated entities, even if it's an acceptable standard or not, or if they need to translate to a different standard.
Yeah, because of the goodwill. This is-
And now perhaps more tax law. The starting point for calculating the globe income is, as said, the financial income or loss of the constituent entity. This is a dependence model, as we call it. Vitor Polizelli has a great article on that. This is dependence model. So basically, you start from the individual accounting, and you make adjustments, additions and exclusions, and you will arrive at a taxable base. So the adjustments which are found in the globe rules, they are all autonomous. So they were created for globe purposes, and they are intended to account for categories of income expenses that inclusive framework members commonly treat differently for tax purposes. When you read the commentary, you find a reference to a typical corporate income tax. So when they are trying to justify each of the adjustments, they will say, oh, this is what the inclusive framework agreed on. So there will be mandatory and optional adjustments. The mandatory adjustments, they have different functions in relation to the determination of the tax base. So some of them are concerned with this idea of a typical CIT, and others are more concerned with preventing double taxation. So, and then again, we'll have a specific class on that. You will have excluded equity gains or loss in treatment for revaluation in case this leads to a gain or loss. And interestingly, perhaps, the policy disallowed expenses, which include illegal payments and fines. So for globe purposes, illegal payments and fines are not deductible. Why? Because this is a typical CIT, and the inclusive framework concluded that a typical CIT would not allow that. Besides that, you also have optional adjustments. In general, what you see in case of the optional adjustments is that they mitigate the detrimental effects of the reference to IFRS. So basically, when you have deviations from the so-called realization principle for accounting purposes, the globe rules, they will allow a optional treatment which allows you to treat the gain or the loss following realization with different triggers. These options, they have to be made for generally for 5 years, and there are specific requirements for that. Something on that, Gustavo?
Chelsea, you have a question.
Professor Shady?
Michelle seems to have a question. Michelle, have you raised your hand?
Michelle. Hi, Michelle. Go on, please. We can't hear you.
Sorry, can you hear me now?
Yes.
Okay, so in your opinion, this difference in the adjustments in the addition of the CSL from Brazilian perspective would make it a different tax, or it's just that the CSL as well? It's the same CSL or it's a different tax? And if it's a different tax, it would be supported and it would be supported by Article 195.
Well, I think it's a two-pronged question, and the second one doesn't necessarily relate to the first one because, for example, beginning with the second one, if it's still on profits, it is within the scope of Article 195. So I think the question for 195 would be, is it still on profits? And you can have a debate that if it's still income if 195 takes into account Article 43 of the tax code and the concept of income does require realization and so on and so forth, that is under Article 43, or if 195 is an autonomous concept. But I don't want to get into that today. But I think one question is it within the scope of 195? And even if you answer yes to that one, then there's the first prong of your question, which is more interesting, and I probably don't have the answer also. If you have legislation defining a tax base, one tax base, if you can adopt for a top up an additional, a different tax base, and I would and mind that I might change my mind on that one. But I would say yes. I would say that you don't need to have a pure single tax base for one tax that is under one competency rule on the Constitution. You can have more than one. And we do have that under our system. You have the presumptive tax and you have the real profit tax. Of course, they're parallel regimes. You're not within both at the same time. But you do have, for example, in the United States, and you do have a constitutional issue there, although courts don't care that much about that. With the AMT, you have the alternative minimum tax. So you have the standard tax with deductions, and then you have the AMT on top of that. So it's not a weird concept. And I think the constitutional issue would be, would they both be under the constitutional concept of income that was defined, or profits under 195? And if they are, I think they are acceptable, even if you have two tax bases. It's not the system is not conceived as a system of if the legislator has defined one tax base, it has to stick with that base for the better or worse. Of course, Schwede will say, well, it has to be coherent and he has to respect equality and fair treatment. But if you are respecting that, it doesn't mean that you can have an alternative minimum tax working on the definition of profit. I mean, the thing would be that the let's say regular CSL and the additional CSL will both be working to define the taxable income. And if they are within 195, which is a completely different question, I think that is acceptable. But then you have to answer if this whole thing is under the 195 or not. And that is something that I won't get into today. I think it might be, but I think, of course, Article 43 of the code does apply. Schwede, I don't know if you have a different view on that. He might not be. He's in the hospital, so he might be answered to doctors, nurses, and so whenever he comes back, we'll get into that. So.
Yeah, for the international audience, this is a very Brazilian discussion. I'm sorry for that. So, Michel, yes, this is a completely different tax base than that of the CSLL, but the consequences of that for the Brazilian constitutional system, I will let you discuss
Yeah,
afterwards.
but you can have a consequence in the international framework as if tax treaties are applicable to this additional or not under Article 4, Article 2, tax covered. If Article, I mean, there's other consequence also, but I don't know if it's the time to discuss it.
Yeah, but in that case, it's the criteria for Article 2 is substantially similar. I would say it's substantially similar to the income tax or even to the CSLL for tax treaty purposes. It's a tax covered.
Article 2 is tricky because Article 2 can be written in a whole lot different ways, and the way that you write it can have a different result. You can just say what taxes are covered, but if you never get CSL there, or most of the cases you won't, but our IRS has resolved that, saying that it's covered for all treaties, even those that don't cite it. So you're kind of good to go on that one. But I agree with you on a typical OECD model article too. I won't see a problem.
Yeah, so moving on, I didn't mention this, but if you look at the initial documents related to Globe, there was a discussion whether the system should adopt a worldwide blending or a jurisdictional blending. We will get into that at some point, but here it's also important to see what is the amount of complications that the choice for the jurisdictional blending brings. Because when I was talking about constituent entities, you need to define the location of the entity, which is an exercise that wouldn't be as necessary if you adopt worldwide blending. And also here, so you have to define globe income, make adjustments to the numbers found in financial statements, but you also need to allocate the income to a certain entity. And this is a complication that arises from jurisdictional blending from the adoption of a separate entity approach. So allocation rules are intended to ensure the appropriate allocation of financial net income or loss between entities and their owners. So the PE is treated as a separate entity. Profits and losses are allocated to it as it would be following IFRS rules. Specific concerns with the allocation of losses are found, and there is also a typology of flow-through entities, reverse hybrid entities, tax transparent entities, and the treatment according to its qualification. So here we will find some level of complexity, which we are not going to detail today, but the idea is that we are able to situate ourselves in the content of the Globe rules. So third step, now we are calculating the numerator, so calculating of the adjusted cover taxes. The rationale for the numerator is perhaps similar from the one of the denominator. There's also a starting point. You start from the taxes included expenses in the entity's financial statements. So that's your point of departure. But the definition of cover taxes is broader than what will be found as expenses in the financial statements. So taxes recorded in the financial statement related to its income or profit, or the portion of income or profit that belongs to it from an entity in which it holds an interest. Taxes on deemed distributed profits are also include. Taxes leave it in place of a corporate income tax, and taxes that make reference to retained earnings and net equity. So again, the starting point is the expenses from financial statements, but the decisive element is the definition of cover taxes. And that's the reason why we will see you also have some additions to the cover taxes. What matters is that the focus is on the substance of the tax, regardless of its name, and without requiring it to be included in income tax legislation. The Globe rules also bring a negative list. So customs duties, payroll taxes are excluded. There may be some level of discussion on which taxes qualify depending on the tax system. There are some rules which we as Brazilians, we read, we don't understand the reason for them, because some of them are concerned with very specific tax regimes, and we don't see the applicability of it. So it's kind of a struggle when reading the rules. So just be assured that it may happen. So as I said, there are additions and reductions to cover taxes. additions may be required because, as I said, the range of items identified as income taxes in financial statements may be narrower than the items that fall within the definition of covered taxes. And the same with regard to reductions. And here uh, it's important to mention that the cover taxes are also the instrument used to address adjustments regarding temporary differences. So sometimes some adjustments to cover taxes will be made in order to reflect temporary differences. There will be a specific class on that as well. So, and here we are talking about QRTCs, non-QRTCs, which at the end of the day is also an issue of a temporary difference, but also the appropriate recognition of losses is addressed through this mechanism. So in summary, cover taxes, you start from the tax expenses reflected in financial statements. You make additions and reductions, but be advised that the cover taxes are also used as means to address temporary difference. So some of the adjustments you will find that there are not necessarily related to the content of the cover taxes, but rather as means to address these differences. Perhaps here also an important issue which will be subject of a specific class. If you could just add all the things from the slide, is the push down of CFCs. It can get more complicated than that. This is the very simple one used for IAR and UTPR purposes. So if the UPE is paying CFC taxes on the profits of the LTCE here in the example, these taxes are pushed down for globe purposes. And this push down is corrected by reference to the numerator. So you will add the cover taxes to the cover taxes of the LTCE. And here in my example, before the push down, the entity had an effective tax rate of 5%, and after that, because of the push down, it goes to 25%. The scenario will be very different for QDMTT purposes. Yes.
You already know my comment, I must do it again. I love this position of OECD because it's recognizing that CFC is not a tax paid on the profits of the UPE, but rather on the profits of the LTC. That's why it's considered as adjusted cover tax of the LTC. Why do I love this? Because when you see the commentaries on Article 7, the OECD says, well, there's no problem in charging CFC because you're not taxing the LTC, but rather the UPE. And now the OECD is recognizing that actually the CFC legislation is taxing LTC, which would be exactly what Article 7 does not allow. So this is inconsistent with OECD being inconsistent with itself.
Yes, yes. This is a very interesting kind of discussion that the globe model rules they bring, because after all, you need to allocate this tax to someone, and I think that for the IAR purposes, the UTPR purposes, they made the right decision. You will discuss this afterwards, maybe not for QDMTT purposes. Someone in the audience, you have to come here, please. Oh,
No, it's just this was a decision not to double tax the income. So it was a pragmatical decision. I don't think that they went conceptually and this should be attributable to the other country. I think they meant not to impose additional taxation on countries or jurisdictions that levy corporate tax at a very low taxation. So I think it's hard to draw a concept out of something that was decided to the benefit of the multinational companies, even though this is not the case in Brazil, because it has the opposite effect. Just wondering whether or not this would be a fair conceptual conclusion out of
But
out of the
Paula,
decision.
Paula, sorry, I'm just saying, what I'm saying is that it is recognizing that the LTC is not under taxed if there is a CFC, because CFC is taxing the profit. The profits of the LTC are not under taxed because CFC is already there, despite not charged by the jurisdiction, the LTC jurisdiction. It is charged on the profits of the LTC. What I'm only saying is because OECD says no, CFC is not charged on the profits of the LTC, and now it's saying the opposite. Sorry, Paula, this is as clear as it could be. I mean, one of the positions are conceptually wrong. And I claim that the first position, the one in the commentaries, this was a political decision. Almost for you, I would say that for a political decision, because this was included in the commentaries, in the last moment in 2013, I really looked for the materials pre the change in the commentaries, and the materials by then they were only discussing whether or not a mainframe would be a PE for you to have an idea. The discussion was still taxing internet and so on. These were the materials preparing the OECD meeting. And suddenly, from nothing, with no preparing materials, they put this sentence claiming that CFC would not be against Article 7. This, yes, this, I agree, was a political decision which had no substance. And now, what I see the opposite. It's completely correct to say that CFC targets the profits of LTC in our example here.
So, okay, I have two comments on that. First, if you're assuming the traditional design of a CFC that targets passive income, this is typical the conclusion that the passive income was shifted abroad, but it technically pertains to the ultimate parent or to the main company of the group. So I don't think that's a fair comparison to that extent, because the IRR and the UTPR are imposed both on passive and active income. So this would be my first conceptual difference. And the second difference is, so the CFC as an anti-abuse rule, as in theory it is, it was designed to disencourage companies to shift profits abroad based on their activities. But if you do the same thing for the QDMTT, you might have the opposite effect. So when you look that they created Article 4.3.3 that is not incorporated in Brazil, they do a concept that you push down and you push up the credits again. So you can, if you have more than 15% taxation on the passive income drawn abroad, you can take it back to the headquarter. And I think, so this is one thing that we should consider when they are conceptually deciding whether or not this is a taxation imposed on the subsidiary or the headquarter. But that this is to say, when it is financial income or is passive income, then I recognize that this could possibly pertain to the headquarter, which I allow you to push back the taxes. But I, at the same time, give you a benefit of considering those taxes in favor of the low tax jurisdiction. So you don't have to pay a second layer of taxation on an income that was already taxed on the headquarter. This is one thing. This accommodates CFC. And then the second thing is, if it is active profits, then you can push down because those are actual operational profits of another jurisdiction. But then the concept of CFC traditionally does no longer applies. I see that Gustavo is agreeing with me, so I'm going to let him.
Thank you, Paula. I must say I don't envy the lecturer from this class on CFC rules. I don't think so. So moving on, next slide. These are the post-filing adjustments. So there are adjustments to a tax liability for a prior year. This is very specific in case of you have an audit on or an amendment of the return to correct an error. So this is the step where you will perform this adjustment. And importantly, this adjustment is done at the level of the cover taxes. And just don't mix this up with the additional current top-up tax, which is a step that will be seen also later. But I think we can rush on this one, unless you have a comment.
It's just that this might look as an exception, but in a country like Brazil, with the amount of litigation and so on and so forth, and assuming that nobody will actually register the liability as a deferred tax prior to audit and litigation, this might come into play as a huge thing, because this is a high litigation country, and this is understudied, in my view, on how income tax litigation might affect pillar two calculation, and when do you actually register the expense and the liability under your balance sheet. So this might be more relevant than we think here in Brazil with the amount of litigation that we have.
On that point, I just want to add very quickly a comment and a not completely finalized thought, but because we're discussing about post-filing adjustment, then you're asking yourself, I went into litigation, I paid the tax, and I recovered the tax. What do I do in year 10? Or I deposited the tax and I received the deposit, or the deposit becomes payment. But the way before that, in 4.1, 4.2 or something like that, I figured out that regarding the current tax, not the deferred tax, but the current tax, the tax that you're supposed to pay, there's a rule that says if you don't pay the tax in 3 years, you cannot consider that as tax paid or cover taxes. And there's also, so that's one thing, in case you go for litigation and you deposit. But most companies in Brazil regarding the governmental subsidies are playing a strategy that involves paying the tax, claiming the Brazilian QRTC, and also going for litigation, which is like they may end up recovering more taxes. Then there's this concept in the GLOBE rules, which I am very puzzled about. They talk about uncertain tax positions, not uncertain tax treatment, because IFRS talks about uncertain tax treatment. They say uncertain tax positions, and that's not a concept that belongs to IFRS. That's not said anywhere. The US has a similar concept, but not the IFRS. And I get the sense that in the commentary to 4.2 something, they are saying that if you have a situation where the taxpayer is saying that he's not going to pay the tax, or he's going against the tax, in a way that he has an uncertain tax position, then he can also not use that amount as part of the cover taxes. And this is a huge problem, because companies that are currently going for this strategy that I'm saying, they may end up not being able to use the taxes that they are paying just because they are claiming it back. But then you're going to say, wow, this is a probable likelihood of success. We're going to win. This is very positive in Brazil because the Constitution or Supreme Court or whatever. But then, that is a fair play for uncertain tax treatment, which under IFRIC 23 says that uncertain tax treatment is when the courts say it is probable or not. So you indeed can say it's a probable chance of success, perhaps. But the GLOBE rules say you have to look at it from the perspective of uncertain tax position. And the definition in the GLOBE rules for uncertain tax position is that a situation where under an inspection, your position is not likely to be sustained under an inspection, not under a court judgment. So if the tax authorities do not agree with you, then you cannot consider that as cover taxes. So this is the only point in the law or in the Brazilian normative instruction that doesn't have a corresponding item in the Globe rules. I refer to the very last article that says if you go for litigation, you cannot consider the taxes in the calculation. So in the end, after reviewing chapter 4 very deeply, I sort of tend to agree with that. It's not paid. You have to pay 3 years.
For the ones who are not here, the question was, what if I deposit? And Victor answered that if I deposit, I have not paid, so it's not a tax paid, and as a consequence, a cover tax for Globe purposes.
Let me ask, different from Victor, and what if I plead for a refund? I pay, and immediately I plead for a refund in court.
That's the case he was talking about. It really depends on the position you take on the refund. It can even then be considered as a non-paid tax, although this is very debatable, right, Vitor? And here is there's a big relation between your Globe income and because of the adjusted cover taxes and your litigation strategy. This thing might be able to change some litigation strategies regarding income tax, and that is very curious. I don't have an answer for that too. That is something that when prior to the law, whenever this question was asked, even for people in the IRS, that was a very unclear thing on how to deal with this, and you know this whole system wasn't built on high litigation countries, and we are a high litigation country, and we will need to adapt on how we are going to calculate our Globe liability with the kind of litigation. If of course, there's one step back because most of the things being litigated on income tax might generate a deferred tax liability in the first place. For example, amortization of goodwill. And the first question that we're going to answer later on is, do we get the 15% in the first place because we registered the deferred tax liability? And my answer would be no, because it doesn't come back in 5 years. So, but that's the first half of the question. The second half, well, on the top of it all, I'm litigating this thing, and how would that play out on my Globe liability, Tatiana?
But on the other hand, I read listing that, okay, I know that I'm under 15, so I can make an payment in I paid more than I really have, and I asking for a refund. So for this year, I have the payment, so I reached the 15 effective tax rate. So I'm not supposed to pay the complementary CSLL, and the next year I already know that my effective tax rate will be 17. So I asking for a refund considering the amount in paid in excess this year. So the other point, yeah.
But I guess the whole point is
It's manipulation.
to avoid you managing your adjusted cover taxes. Then there's the view that if you want to get it back anyway, you cannot consider it paid. But it should be a thing that it's a given that you get it back, and not more probable than more likely than not. It's not a criteria that I would accept. This to avoid manipulation, it's something like, yeah, you paid more and it's a given that you paid more and you get it back. Then I fully agree with you. But otherwise, come on, it's just because I'm litigating, you're not gonna treat it as tax paid. That's something very different.
So the last step of today is the calculation of the ETR and the top-up tax. There would be a fifth step, but we are not going through this today. So the calculation of the ETR, if you can, the ETR is calculated, by now it's obvious, on a jurisdictional basis. The top-up tax is charged only in cases where the ETR is below the 15% minimum rate. That's the idea of the glass. But the complete formula for the top-up tax, the jurisdictional top-up tax, is this one. So the one from the beginning of the class, I made like a simplification there. I only showed like top-up tax percentage times excess profit. But actually, we also have plus the additional current top-up tax minus the QDMTT. So this is the complete formula for the calculation of the jurisdiction of the jurisdictional top-up tax. The excess profit is the difference between the net globe income and the substance-based income exclusion. The net globe income is the sum of the net globe income, the globe income of all constituent entities, and the substance-based income exclusion is the payroll carve out for all CEs plus the tangible assets carve out for all CEs. So this is very important because it's possible that the carve out of one entity at the end of the day neutralizes a top-up tax which would otherwise be due to a under-tax profit of another entity. So you can sort of also blend the carve-out, if that's a figure that helps you think about this. So this one is in green, turned out really bad, huh? So it's 5% times the payroll costs and 5% times the carrying value of eligible tangible assets. You have the transitional rates. By now, you all know this. So these transitional rates, they make a lot of sense for me. So the impact in the first years will be lower than in the last year. So the full 5%, so the full application of the globe model rules with the only 5% carve out will only be applied in 2033. Okay, until then you have the rate for the carve out, which will be higher. As a transitional measure, if you read through the documents, you don't find much explanation about it. The explanation is that this is a transitional measure. Okay. And again, we are just rushing through it because you have a class specifically on the carve out, I believe. Yeah. The additional current top-up tax, there are 5 provisions that require or permit retroactive calculation of the ETR. They are a defined term in the globe model rules. If you look at Article 10.1, there is this ETR adjustment articles. It's a defined term. And ETR adjustment articles means this, and that. Okay, so it says which are the ETR adjustment articles. And these cases will refer to a recapture of deferred tax liability, an adjustment to an aggregate asset gain, adjustment that leads to a material reduction in covered taxes for a previous fiscal year, an adjustment related to an unpaid covered tax, an adjustment in the context of an eligible distribution tax system. So this is kind of a summary of the content of those provisions. Okay. Importantly, this does not refer to temporary differences. They are actual corrections. So if you somehow conclude that something was wrong in the calculation of a previous period, you will have to correct this through the additional current top-up tax. The idea is that you don't have to reopen your ETR calculations and make corrections to the returns you delivered in previous year. You will correct in the year you identify the problem through the additional current top-up tax. And this is clarified along the commentaries explaining that reopening the calculation of the globe returns for previous periods would be very bad. They wanted to avoid that, and they created the additional current top-up tax mechanism. And finally, you have a deduction of the QDMTT. If it's not a QDMTT but a DMTT, it will be likely treated as a cover tax. And here's it makes a lot of difference. I don't know if it's clear for everyone by now, but if it's not a QDMTT, it will be treated probably as a cover tax. So it will reduce or it will increase your ETR. This is good, but it will come in the calculation before the carve out. So this means that in order for a DMTT to neutralize the tax that would be charged under the IIR or the UTPR, it would have to be higher than the neutralizing version of the QDMTT. So during the discussions in Brazil about the QDMTT, everyone was saying it's very important that we have a QDMTT and not just the DMTT. And that's the reason why, because the QDMTT comes as a deduction after the carve-out was already considered. If it's only a cover tax, then it will come before the carve-out, so the amount that would have to be charged would be higher, and this means higher taxation. I have quite a long article on this topic in the World Tax Journal. I will comment on that on Thursday, and it's on the readings. I hope you read it. And perhaps here is just for systematization purposes. There are also de minimis exclusions and the safe harbor, which are elective mechanisms. So you have to put them somewhere in the 5 steps, and this is where they go. You will have also a class specifically on this. So that was the end of the first part, and now we get more theoretical. Are we going on? Okay. Can I use the click myself? It will be better. Otherwise, I'll get lost. So again, this green is really bad. Can you see the plus 30 here under? No? Okay. So this should be minus 800, and all the entities which you don't see anything, there is a plus 30, okay? And so here, if you do the calculations, you would have plus 120 minus 180. So this means that when you blend these entities below the red line, you will come to a loss. Okay, this is a loss position when you consider the blended entities in this jurisdiction, and because of that, no top-up tax would be charged. Okay, so the jurisdictionally blended entities are at a loss position, but so it's minus 60 here. But if you add this border here, what will happen is that the result will become positive for this side of the border. So you have plus 40 here and minus 800 here. So I didn't change anything. I only added a border. So the M&E group is exactly the same. Nothing has changed from the perspective of the ability to pay of the M&E group. Only one thing has changed. One entity which was located in the same jurisdiction as the others went to another jurisdiction. And this completely changes the calculation for globe purposes. Okay? And you can add another border. And if you do that, you will come to a conclusion where there is minus 100 here, plus 90 in the other jurisdiction, and minus 50 here. So basically what I'm doing this here is by adding borders, I increase the top-up tax. Okay? And there are a couple of authors who argue that the globe model rules, they are aimed at the ability to pay of the M&E group. Is it though? Because this is the very same M&E group with the very same characteristics. What changed here is merely where the entities are located. And the tax treatment for globe purposes changed entirely. So I came out from a situation where there was no top-up tax to a situation where I was able to increase the top-up tax. Okay? And here perhaps a more theoretical discussion. Um, the creation of a floor to tax competition is the only clear purpose of the rules. It explains the choice for jurisdictional blending. So this is number one in this book. So if, I have like 20 something theses, which I listed as a conclusion. And the first thesis is this one. The only clear purpose of the rules is the creation of a floor to tax competition. Ability to pay. Can you find any entity that is treated consistently throughout the rules? And after writing the book, I concluded, no, it's not possible to find a subject that is treated consistently all the way. You can think of a situation of a loss-making M&E group. So if you combine the entire group entities, the M&E group is at a loss. It's still possible that this group is subject to a top-up tax somewhere, because it depends on how the entities are disposed throughout the globe. It's also possible that a highly taxed M&E group, so if you look at the effective tax rate of the group as a whole, the group is subject to, I don't know, more than 30% effective tax rate. But in a certain jurisdiction, it is low taxed. For globe purpose, it doesn't matter. It's looking at jurisdictions. And ability to pay is not concerned with the borders. So if you are located in jurisdiction A or B, if you structure your group to have 3 entities in one jurisdiction or 1 entity in each jurisdiction, this has nothing to do with ability to pay. So the ultimate goal is simply to create a floor to tax competition, and Gustavo disagrees.
I was just going to ask you, can't you say exactly the same in regard to transfer pricing? I mean, once you take an entity approach and not a group approach, can't you? I mean, if your arguing ability to pay relates to the group, which I agree with you, then we need to get out of transfer pricing yesterday.
Sorry, Gustavo, sorry. I think
Sorry.
just to say, what Ricardo is trying to say is that because transfer pricing was never conceived as a group issue, but rather as an entity. At least this is at least the original idea of transfer pricing, comparing entities in the same jurisdiction. It has nothing to do with group. It is true that transfer pricing has evolved. Presently, they don't know exactly what they are doing, but transfer pricing originally is an entity issue and not a group issue. The problem is that in Pillar 2 and Pillar 1, but both of them, they forgot this idea of entities and they are talking about groups. They are following more or less what Ruven likes. And we heard Ruven Avione yesterday with this position of this unitary approach whatever it is. And he tried to defend unitary approach. And Ricardo is here showing, sorry, if you want to adopt a unitary approach which has nothing to do with transfer pricing, then you should be consistent on this. And Pillar 2 is not consistent with unitary approach or with a separate entity from a ability to pay principle. Ricardo, I fully agree with you.
Just getting back to Gustavo. Transfer price is separate entity based. Can you agree on that? So it treats separate entities consistently. That's what it tries to do. But when you look at Globe, it doesn't treat M&E groups consistently. It doesn't treat entities consistently because you can have a loss-making entity which will be able to blend under tax profits of the entity in the same jurisdiction, and you come to a zero. And that's my bullet here. Jurisdictionally blended entities is not a subject that can be justified exclusively on the ability to pay. It's floor to tax competition, but ability to pay, I can't find a justification here. Paula, please come forward.
That can be profit shifting between them to allocate in the same manner as here.
We not hear you.
No, it's just that transfer pricing doesn't control transactions between entities within the same jurisdiction. So you can allocate profits between them. So you cannot say that transfer pricing really does an entity-based ability to pay approach within entities within the same jurisdiction, because it doesn't control within the jurisdiction. So why is it so different than here?
This is gonna be on YouTube forever, apparently. Transfer pricing, in order to shift profits in transfer pricing, you need to have differences of tax rates. If you're in the same jurisdiction, you won't do that. So that's why we don't control it.
Yeah, besides presumptive systems and different tax rates within the same country, but a loss on a profits is the same example.
The recording thing, it's just so it's so detrimental, but that's fine. I can't even think straight, but no, so I think conceptually it should be viewed ability to pay when you compare within the jurisdiction the tax burden within the market if you consider a multinational and a local company. So the argument for taxing multinationals at a minimum rate is that they compete unfairly with local companies within the jurisdiction. So, and there is a difference in ability to pay, because ability to pay is not only the financial result, is cash flow availability, asset availability, power availability. So all, if you take the unitary approach, you can see that as a unit, multinational companies, they have substantial advantages over local companies. So if you consider ability to pay under a broader concept of what a company is, and you compare how it competes to local company within each jurisdictions, you can find a reasonable argument, which I think if even fits ability to pay, not only competition, because if you have to consider ability to pay not only the financial results, but all the pool of what a company can take. And Shueri's course on income tax, one of the articles that grounds the corporate taxation discusses this, how companies deal with society in general. I think it's Avionas, I don't even remember, but it's kind of the first or the second. It has been many years. So that would be my argument. And I think this even correlates with a world that deals with taxation through a capital import neutrality lens. that companies from abroad and local companies should be taxed under the same rate. You're gonna beat me for this argument, so please not. Remember, it is recorded.
I don't agree with it, but I won't get into it. Suffice to say that I'm happy that transfer price is not okay. That's where I want to get to. So because if you want to check ability to pay, you have to go with the actual taxpayer and who's actually bearing the tax burden and not the whole entity approach and anything. So I agree with you that is the only purpose is to curb harmful tax competition, and it's not even doing that well because of all the exceptions, the qualified tax credit and the whole thing. But to say that transfer pricing is super ability to pay and this thing is, and that's where I kind of find it hard to assert because they both have, in my view, the same issue when you look at the entity. But
Yeah, a requirement of a thesis is that it must be controversial. So, also, something I contend in the thesis is that the globe model rules, they do not have the structure of anti-abuse rules. They apply regardless of subjective and objective elements that could be treated as indicative of abuse. They address the behavior of states and then not directly the behavior of MNEs. So at the end of the day, what the globe model rules are trying to do is to force jurisdictions to increase their tax revenues or increase their tax rates or even adopt QDMTTs. The greatest impact of the globe model rules was not on the behavior of the MNE group, it's on the behavior of the states. So who answered to the globe model rules as we see now? There is some trend or some attempts from MNE groups to avoid the application of the rules whenever possible. But besides that, what you see is that the states are reacting to the globe model rules. And that was the goal all the way. And another important aspect is that the globe model rules, they are not intended to enforce the single tax principle, whatever this is. And here I make I point out in the thesis that depending on the author, you will find a different definition of single tax principle. So here, corporate profits should be subject to a minimum tax, and if the country with the primary right to tax such income does not impose tax at the minimum level, the other country involved should tax it. So this formulation, which is found in Aviona's article on Pillar 2, is kind of different when compared to the original formulation in the early 2000s. So, and you also have other theses around the concept of single tax principle. But the point is that jurisdictional blending still allows for the non-taxation of income from an entity. So this is not the goal we're aiming at if you are allowing for jurisdictional blending. And you also have the carve out, you also have the 750 million trigger, and so on and so forth. There are several arguments against the single tax principle defense. Now, on the subjective scope, I would like to go into some policy choices in the definition of MNE group. So the definition of MNE group is very broad and it takes only control into consideration. It leaves behind any form of integration requirement. As we saw, the relevant definition is the one used for IFRS purposes. And the consequence of that is that an M&E group is not necessarily a synergistically managed enterprise. So an M&E group can be just a bunch of consolidated entities which bear no relationship on management, and you can have a merger that was due to a business opportunity of the controller, and it has no intention of blending the activities of this merged entity with the remaining activities of the group. this policy choice, it creates effects on the tax object and on the charging rules. I will show an example of that. Uh, and it also operates to the benefit of the taxpayers. So it allows for the blending of corporate constituent entities which present no integration with each other, as well as for the charging of a type of tax on a constituent entity which is completely unrelated to the low taxed one. Let's go to the example, but before that, there's as I mentioned this before, there was this important choice. No, this I did not mention. So what I'm saying here is that there were two policy choices when defining the M&E group. You could resort to ownership thresholds, which is what has been done, and you could resort to the so-called economic criterion. You can compare the experience of the US unitary business principle and the German Organschaft. Uh, they had at some point this integration requirement to define the M&E group, which basically requires the activities of the entities to be synergistically managed, and this creates several problems of applicability of the rules. So the case law on these issues is enormous. The rules are of difficult application, and the experience shows that using integration as a requirement for the definition of a group is not a good idea. Ownership thresholds are the most broadly used criterion in group regimes. They have a more feasible application, and that was the choice of the globe model rules. But this also brings some impact. So I'll try to take this out of here. So how do I take out the... So this one on the top is Scrooge McDuck. It's two patinhas. I don't know for the Spanish speakers. I know there is a Spanish speaker in the group. But the idea is that he controls 4 subsidiaries engaged in the business of batteries, another engaged in the business of bricks, another in the business of diamonds, another in the business of dairy products. He controls it through his UPE, and he has acquired these entities at different years, and he has done that because that's his strategy. But when he bought the battery company, he bought it because he believed this was a good business. He didn't want to intervene in the management of the business. He did it at almost as an investment decision without wanting to influence or merge or create synergies with its own existing groups. So I use this. This is based on a concrete example. There is a group that has done something similar to that. But the point is that under the globe model rules, you can simply merge the profits and losses of all these entities as if it was a single group for tax purposes. So it's treated as a single entity for the purposes of the globe rules. And here again, we can create the very same issues with blending. See here that in this jurisdiction, you are blending the losses of the battery company with the profits of the brick company. And there you're blending the profits of the dairy company with the profits of the diamond company. And the problem can go even further if you add a UTPR in the scenario with a minority shareholder. So what I presented here is a situation where the dairy company has minority shareholders who hold 40% of the capital of the dairy company. And in my example, he will be charged under the UTPR a top-up tax on the profits of the brick company and of the diamonds company. So, okay, you can say that from the perspective of Scrooge's McDuck, this is somehow fair, but from the perspective of the minority shareholder of the dairy company, I can't explain that, because the tax will be charged on the dairy company, which means that economically, the minority shareholders of the dairy company will also be charged on the under taxation of a brick activity from which he does not benefit ever. So the profits of the brick company will never go to the minority shareholder of the dairy company. The profits of the diamond company will never go to the hands of the minority shareholder of the dairy company.
That is a big problem with ability to pay. Going back to our previous discussion, and, you know, the whole thing about the system is, and which would make it acceptable, minimally acceptable, is that UTPR was made not to be charged ever. It is just there to be like a ghost or a skeleton in the closet that is going to spook you if you don't put the IR in place or to kill the MTT. Because if you start wondering about the effects of the UTPR and on the concept of income and ability to pay and so on and so forth, this is unacceptable. The problem is that can you legally create a ghost that can be applied from time to time, but it's meant not to be applied, but it needs to be there for the system to work, at least for the system to work without a multilateral treaty. That is the point. So yeah, here I fully agree with you. Just not to leave it in the air that here is just completely out of the scope.
Any comments from the audience? No? Is Paula gonna make the case for ability to pay here?
The
Okay.
question is also whether Professor Liona would make the case for this unitary approach with this case.
Sorry, Professor Shady.
The whole idea of Ruvens is this unitary approach to say it's only one company, and it should be taxed. See, only one group, one tax, one profit of the group. But I mean, in this case, which I'll show you here, it makes really no sense. I mean, no accountant. Gustavo is a professor for accountant also. No accountant would dare to say that you should have only one balance sheet in this case, because you have really different entities, different businesses. So this is clearly a problem. You cannot consolidate this from an accounting perspective. You consolidate businesses and not partners.
Yes. There's comment from the audience.
No, but because in the example, the company is consolidated, it's controlled company. So the accounting prefers the controlled, although for the consolidation. So if you have the control, you need to consolidate and you need to show up as a liability the position of the minority shareholders.
Yeah, but just to insist on this from an accounting perspective. You want to
I agree
whether the business is making profit or loss. In the business of milk has nothing to do with the business of diamonds. So consolidating both of them is from an accounting perspective wrong. Accounting perspective, you should not never consolidate both of them because you give no information to shareholders at all. If you, I mean, it's correct to consolidate companies which are separate entities, but which are an entity as a whole. Here I see four different entities. The battery one, the bricks one, the diamond one, and the milk one. There are four entities here. But when you consolidate on UPE, you bring no information because you don't, the investor will never know whether it's a good or bad business because you cannot understand the business. So this is from an pure accounting perspective. You should consider an entity as a business, and you have here four different businesses.
Yeah, I think it's like I don't know if I have like my accounting basis. For me, it's like very usual. You make the consolidation considering the control, and because the parent company has all the risk of the business, and they take the decision with all the assets and the liabilities. So, and the consolidation rules in accounting is just based on the control of assets and the financial statements, and this is the reason. So, but I understand your arguments on the income perspective, on the business perspective, that there are four different business. But
Yes.
on the UPE perspective, he controls and he defines the financials policies, and the how the company, the cash flow of the company. I don't know if
Tatiana,
Gustavo.
Tatiana, just to say, you're correct. Considering the Brazilian law, you consolidate based on the control, so you're correct. I say from a pure accounting perspective, yeah, the whole idea of the accountants is to inform whether a business, an investor, inform a business, the investor, whether this is good or bad businesses. And if you merge the four businesses here, you bring no information to anybody, because the investor doesn't know whether to invest or not, because he doesn't know whether it's a good or bad business. But just to say, I'm criticizing this from a pure accounting perspective. But what Ricardo is showing is that from this global perspective, they are merging things which have nothing to do with each other, and even worse because of this jurisdiction approach. So it becomes a nonsense what they're doing there.
Yeah, I believe that one important thing is that the consolidated financial statement, it has mostly an informational goal. And for the purposes of this consolidation, you will be able to see that there are different business segments which may be either loss-making or profitable. So this informational issue you wouldn't have. So when you look at the the consolidated financial statement, you'll be able to see, okay, this is a good business, this is a bad one, and they are all under control. What won't happen in the consolidated financial statement is this idea of blending losses of the battery company with the profits of the brick company. So this happens for global purposes, but you won't see, in fact, you won't be misinformed to the extent that you will think that, okay, this is not loss making, this is profitable, this and that. So, and that's the struggle of using something that is destined or aimed at informing the stakeholders to, after all, calculate the ability to pay of whoever is concerned. And here it's obviously a shortcoming of the globe rules.
Yeah, just to complete a little bit what Tatiana was saying. I mean, if you're thinking about the investor perspective, if you're investing in the UPE, you need to know it all. And regardless of it having 5 line of business below it, you're investing in that company. So it's a public company. Of course, they're going to consolidate it. I mean, from a managerial perspective, of course, you want to know which business is doing what and which one is making a profit or not. But from an investor perspective, you're investing in the UP. So why wouldn't I have the consolidated result for it? Of course, I might want to challenge the administration. Well, you're getting into that line of business, and this is not good, and I want to have information on that. But it is a choice, and
Gustavo,
yeah.
I think you could as an investor, you would invest in sub 3 only if you had this information.
Well, but then is the sub 3 a public corporation or not? If it's a public corporation, yes.
If it is a public corporation, but it is there's a controlling shareholder. It's still you consider UPE the controlling shareholder, even if sub 3 is is a public company also.
It doesn't matter because if I'm investing in
It
the
does.
UPD, I want to look at the consolidated results.
Sorry. If you're investing in UPD, but once again, what if you can invest in something which happens to be also a public company, and you could make profits there? Why would you invest in UPE? I mean, just to give you concrete names in Brazil, I can decide whether I want to invest in Itaú or Itaúsa. Both are public companies, and you can choose to give a concrete case here.
Yeah, but if I
I
want to
mean,
invest in a parent company, I need to know the consolidated thing.
Sorry, in my case, in my example, Itaúsa would be the UPE and not Itaú, despite the, sorry, giving the name, and most probably I'm not considering the case as a concrete case, just to mention that it would make much more sense if you would allow, if you would consider the business, because this is the purpose of accountants also. Well, that's my opinion.
Well, you're not wrong, but the thing is that consolidation with the UPE is also not wrong. We have a time restriction, so I'm not going to go further into this. But no, you're the boss.
I may be wrong. I may be wrong, but once I read the text by Lisa Martins explaining that it would be a British approach and a US approach, and maybe this is the difference here, because there's a text of Lisa Martins which he brings the concept of entity, and he says once you have an idea of entity, then you have all the answers, and what is the entity, whether it considers control or whether it considers the business itself. This is the issue. There's a fantastic text by Lisa Martins on this. I think published in, I think it's Direito Tributário Atual, but I'm not sure. I can't hear Ricardo.
It's on purpose.
Let's see.
I'm you know that I'm clarifying the actual structure here, so it's from a through example, which I sometimes use, but when it's too public, I don't. So moving on, perhaps this is a bit complicated for 20 minutes. I'll do my best. So there is this idea of are you familiar with the notion of economic rent? So there is this idea that the globe model rules, they would be focused on excess income, and there are several instances in the commentary where you find reference to the carve-out as avoiding any tax-induced distortions of investment decisions. This is very bold. Huh? They say that the design of the carve-out avoids any tax-induced distortions of investment decisions. And they also say that conceptually, excluding a fixed return from substantive activities focuses globes on excess income. Excess profit, excess income, economic rent are all terms that are used sometimes interchangeably. And basically, you look at the inefficiencies of corporate income tax, you will find that it has inefficiencies related to the allocation, to the financing, and distribution. So the criticism to corporate income tax is that it would distort investment decisions, because an investment decision is undertaken only if it is expected to generate at least a normal rate of return. So traditional CITs, they tax normal returns and represent an additional cost to investment. On financing, the corporate income tax, it would create a debt bias. So interest payments are deductible and dividend payments are not. And this is what the literature called the debt bias, the idea that financing through debt is better than financing through capital. And finally, the distributive distortion would be that corporate income tax would shift the burden to workers. So some people believe that corporate income tax is very progressive, and let's say that, but you have empirical accounts, and I quote here the studies, you can look it up if you want, about 50% would be shifted to workers, and some will say that from 30 to 35% of corporate income tax will be shifted to workers. So that idea that the corporate income tax is a tax on the dividend of the shareholder, you have to be a little late on your economic studies to sustain something like that. Uh, and then my green won't work here. There is the ACE, the Allowance for Corporate Equity, which was conceived as an economic model that would correct all of these distortions. So it would charge only what's in excess of the normal return, and therefore correct the allocation distortion. It would correct also because of that the financing distortion, because it would allow for a deduction related to the on capital. And as a consequence, the distributive impact would also be corrected. A tax on economic rent would be a tax that burdens the shareholder and not the workers, at least from the economic modeling perspective. And there is an article by General Devereux and Freeman, General Neutral Profits Tax, where they define the economic rent as returns that exceed the opportunity cost of capital. So you need to allow two deductions for that. The first one is economic depreciation, and the second is the opportunity cost of finance. And this all was to explain what is meant when they say that the carve-out would avoid any distortion on investment decision. They are basically claiming that the 5% carve-out would equal to this creature here that would turn the CIT on a tax on economic rent. And I disputed this position for three reasons. The first one is that the carve-out does not consider intangible assets. So just imagine a group which is in the automotive sector, and it buys an iron ore, and it pays a goodwill for that. The goodwill will be registered as an intangible asset, and therefore no carve-out on the goodwill could be calculated. The carve-out will be calculated based on the assuming here the tangible assets of company A, which is in the amount of 100, and that 20 would be left behind. This is a shortcoming when the economic model is considered, and there is no anti-abuse reasoning for that. The asset is not highly mobile. So when you read through the rules, you will find out that they claim that you can't allow a carve-out on intangible assets because intangible assets are highly movable. So you could do some tax planning and allocating your intangibles where you are low taxed, and for that reason you would increase your carve-out, so it would not make any sense to allow for a carve-out on the intangible assets. And that's the position you find in the rules. And here it is an example of why this reasoning maculates the idea that the globe model rules would charge only economic rents. The second one is the adoption of a fixed rate. So 5% is applied wherever you are located. So 5% may make sense as a cost of capital, as an opportunity cost in some jurisdictions, but in Brazil, we know it doesn't. So 5% as opportunity cost, it doesn't make sense at all. Our public bonds, which could be treated as the economic, the opportunity cost, they pay much more than that. So here I compare then a jurisdiction which has a 5% public bond with another one with a 50% public bond. So you cannot simply equate the economic costs in both cases. So the critique is that the carve out of 50%, 5% should be variable according to the jurisdiction. So 5% makes sense for Europe or for the US, but for Latin American countries, it doesn't make sense at all.
an adjustment like that is not a stranger to transfer pricing, right? We have country risk adjustments for transfer pricing adjustments. So we could have something that would equate that. I mean, you basically would need to refer to the Modern again and get his risk adjustment rates and do an adjustment rate for the expected return and what would be a normal return in a certain country. On the one hand, it allocates more to Brazil on transfer pricing. You would allocate less top up to a country like Brazil because the expected return in SBIE would be higher. So yeah, you could do something like that because 5% of a board is just you import something from the guilty, which is done for one country, and then you intend to apply it to the whole world, and it's not like that. It won't work like that.
Sure. And this is an important criticism that in academia we can make, but you don't find enough impact to this sort of discussion. So I never heard anyone reproducing this kind of argument. So it's convincing. Like, why do you use a fixed rate of 5% for whatever jurisdiction if your goal at the end of the day is to focus the globe model rules on economic rent? And in the end, this means that the global model rules, they are more distorting for a developing country than they are for a developed one. And that we don't find enough discussions, and we are in academia in Brazil, and perhaps it's our role to do that. Yeah, so Paula is saying that developing countries are allegedly the ones that asked for the substance-based income exclusion, but I have another paper on that. Maybe I could share. It's not published yet, but the impact the carve-out has on developing countries is much worse than on developed ones.
Ricardo,
Sorry, Professor?
we just asked you, would it not be the reason for the carve out would be that developing countries want to attract investments, and therefore they don't want to be, they want to grant a minimum of tax incentives, and they don't want to be punished, provided these investments are what would be considered real investments. I mean, that's why the carve out would be brick and mortar, to say if you a developing country wants to give a tax incentive for brick and mortar, we have nothing against this, or at least we will respect your political decision to grant a tax incentive. This seems to have been the reason, at least for the discussion. As you know, I have even a text discussing this, to say that this allows developing country to attract brick and mortar, but not to attract intangible, the development of intangibles. That means it's okay, provided it's only brick and mortar, which brings less value, or you may bring tax incentive, you may grant a tax incentive, but don't you dare to grant a tax incentive for what really matters, which is intangibles.
Yeah, and if you think about it, you can consider that, for instance, the M&E group in a developed country, it has already people and tangible assets. And because of jurisdictional blending, which, as I showed, includes the carve-out as well, these tangible assets, they're going to be able to offset the tax incentives given on intangibles. So this means that a developed country, which for instance, already has a plant there, already has specialized workers there, it will be able to still offer tax incentives related to intangibles because of jurisdictional blending. But if you're a developing country, you don't have the tangible assets yet. You don't have the personnel, the highly value-adding personnel located there. You won't be able to give the same sort of incentive. So the carve-out combined with jurisdictional blending, it kills the ability of developing countries to offer intangible related incentives, but developed countries are still able to do that to a great extent. And that sort of criticism, we don't find it discussed enough as I see it. And finally, there's also a third reason why the carve-out is not focused on economic rent. It's because you can't carry forward the carve-out. So if you don't use the carve-out, so imagine the investor acquires an asset for 400 without depreciation, for the example. In year one, it has income of 0 and the carve-out of 20 on the 400. So the excess profit would be minus 20, okay? But in year 2, it can't carry forward. So minus 20 again. So everything repeated, no income at all. The substance-based income exclusion is still 20, the excess profit minus 20 again. So in year 3, it finally has 40 of income. The carve-out is 20, and therefore the excess profit minus the carve-out is 20. And it has 60 in year 4, substance-based income exclusion. Again, 20, excess profit 40. You see that 20 and 40 in years 3 and 4, they are excess profit. So top-up tax could be charged here, depending on the situation. But these amounts are still normal returns, because he's simply recovering what he has invested in years 1 and 2 and didn't he was not able to make any income in the first 2 years. Okay, so basically the conclusions summarize what we have discussed, and thank you for your attention. Questions? And of course, we are open for questions.
Also want to add something, I suppose. Just a quick comment on what you just mentioned, Ricardo. I guess I got that from the Vela text as well. One thing that's also a big question, since we're discussing the exclusion, economic rent, everything, one point that should be also allowed a deduction or of somehow is incentives for research and development. There is a criticism about BEP Section 1 turning into Pillar 2. All out of a sudden, many aspects of Pillar 2 simply came out of the blue, right? And one thing that should be there to be consistent with I guess a pillar BEP 6, right? The one that discusses harmful tax competition, and they came out with the conclusion that certain patent box regimes are allowed, and there are several criteria on how you can implement that. But then countries are modifying their legislation to create patent box regimes according to the BEPS project, but those patent box regimes are not allowed an exclusion for Pillar 2, so that's absolutely a paradox. And that's also important for Brazil, because we have the Lei do Bem, and everyone's asking themselves whether we will need a QRTC adaptation for Lei do Bem. Anyway,
Someone else?
All right, guys. No other questions? You sure? Oh, Paula, come on. People are going to watch this and they're going to have a grasp of what is to do a course here in the post-graduation course. So it's going to be good. It's a big incentive or not, but no, the exposure is good. All right, guys. Thank you very much for all the comments and participation. Ricardo, I cannot thank you enough. Really, really great. And see you tomorrow. All right. Thank you. Good evening.
Gustavo, just allow me to join you in thanking Ricardo very much for this class he gave. This lecture, it was fantastic. congratulations, Ricardo, once again. You know how much I admire your work. And it's good that now more people can understand why I admire your work. Thank you for this.
Thank you, Shuedi. Thank you for being with us, even though from afar. And I hope you feel better soon. All right, guys.
By the way, just before the class, my doctor did not allow me to go in presence, even if I feel well, because I hope I shall feel well tomorrow. He said that this week I'm not allowed to go in presence. Next week, yes, but
All right.
and unfortunately, you know that there are some laws which you try not to follow, but when it's a law made by a doctor, you do follow because you know the consequences afterwards.
All right. Thank you. Get better and good evening. See you tomorrow.